Hi, everyone. This is Jason Barrick of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He's a former Chief Financial Officer or CFO of Silver Wheaton, and he's currently the co-founder and CEO of Sandstorm Gold. They have over a $600 million market cap. Nolan Watson, thank you for joining me again.
Well, thanks very much for having me.
Now, Nolan, before I ask you specifics about your company, I want to ask you about the gold price. Why, in your opinion, has the gold price had such a large rally since December?
Well, I think the underlying story that existed back when gold ran during 2009, 10, and 11, which was of increasing debt around the world and asset bubbles and a risky economy, those fundamentals never went away, but the storyline did, and people started focusing on Fed increasing rates and strong employment in the U.S., and that really hurt gold. And we're starting to see that same narrative come back into play, where there is people are worried about Brexit, but with an underlying concern with the balance sheet of companies, the balance sheets of governments. We've got companies like Deutsche out there with assets that are about equal to their liabilities, where their market cap, they're a major bank that has the potential to bring down the world system, and although they're not imminently about to collapse, whenever your market cap gets down to 1.2% of your total liabilities, there's not a lot of room to move. People are worried about China and their levels of debt, and so the concern of what's to buy right now is high if you're an asset manager sitting on money, and people are turning to gold.
Yeah, and those other asset markets like stocks and bonds, those things have been in a bull market for a while. They've rebounded very nicely. They've gone up so much, people were wondering the underlying fundamentals of the global economy. Can it support higher and higher asset prices? The other thing I would add, too, about the debt, we've had a debt problem for a very long time. Now we're into negative interest rate territory. I think there's $12 trillion now of global government bonds that are in negative interest rates.
Well, exactly. Whenever you're in a situation where there's a whole bunch of money sloshing around in the system because governments have been doing quantitative easing for so long, and governments and central bankers specifically are taking interest rates down to zero, and as you said, in many cases negative, with $12 trillion of government debt around the world trading at negative yields, you have to ask yourself, where do you put your money? If you have money and you're sitting on it, where do you put it? Do you pay a government to hold your money? Well, that sounds like a bad idea to me, although $12 trillion worth of money is currently doing that. You put it in real estate. Many real estate places around the world are just ridiculously, I don't want to say overvalued because they could go higher, but are at all-time highs. Do you put it in commercial real estate? That seems to be at an all-time high right now, with commercial real estate trading at 3%, 3.5% cap yields. Do you put it all in the equity markets, which maybe some of the equity markets make sense, but there's this fundamental question out there. If you're sitting on a lot of money, if you're sitting on millions or billions of dollars as an asset manager, where do you put the money? And that is that's the $12 trillion question right now.
Do you also think gold, another reason gold had a major rally besides the Fed, not being able to raise interest rates more around December again, was that there was supply side problems in the gold market, in the physical gold market, that a lot of the gold miners, the primary ones and the base metal ones that produce gold as a byproduct, when gold got down to 1075, that was a point where if gold had gone much lower, we were potentially seeing mines being shut off?
Yeah, it got to a point where a number of mines were imminently being shut off, and some did get shut off down when the gold price got close to $1,000 an ounce. A number of mines were being shuttered. And in fact, I can think of a few mines where they announced that they were about to shut them down, and they've decided to hold off now that gold's come back up to $1,300, but they're just hanging on by a thread right now, and you're going to need to see prolonged and significant price increases for those mines to have any serious longevity. We're certainly not at a place price-wise in gold where it makes sense to build very many mines. There are a few high-quality, world-class mines out there that it does make sense to build, but they are few and far between, and they're the exception, not the rule. So there's still a substantial amount of supply-side constraints with new production coming online, and I would be willing to bet that there have been enough mining companies high-grading their assets during the time where gold prices were low just to stay alive, just to be able to make their debt payments, that eventually that's going to come back to bite them, and that their average grades are going to come down, and that their mining companies have been mining above their reserve grades. They'll have to start eventually mining average reserve grades or below, and that's going to impact their cost of production as well. So as you said, there's a tremendous amount of supply side constraints still.
Yeah, that was actually one of my next questions. I was going to ask if we're currently at a gold price where a lot of new gold mines are going to get built. I'm seeing some gold mining companies that want to restart production or build a new mine releasing, these economic studies, PEAs or pre-feasibilities, and talk about how they have a low-cost project and their all-in sustaining cost is $1,250 gold, and they, have a very, very marginal return, only like 12% net present value, internal rate of returns, and things like that. So, I mean, those types of projects with high capex and low returns at $1,250 gold, those things are not going to get funded. That's not low cost.
No, it's not low cost. And this is the type of thing where you see it every time the price spikes up a little bit. Everyone who is sitting on a project that doesn't make sense to build starts putting out press releases again about what a great project that they have that everyone else has forgotten, when the reality is the project was poor before the commodity prices fell, and the project is still poor now, and it's not going to get built. I'm actually kind of concerned for the industry to a certain extent. A few months ago, I was sitting down with a list called the Takeover 20, which is provided by an investment bank of the top 20 takeover candidates in the gold mining industry. And although there were a few good names on it, there were a lot of names that were a significant stretch, and there really aren't that quality of projects. And in the last few months alone, probably 25 to 30% of those companies have already been bought. And when you look at the list of companies that was left, it's on average very low quality, and half of those mines I certainly wouldn't recommend building. And that's worldwide, and that list is all encompassing. And so if you think that there's only a handful of mines out there that haven't been bought yet, and junior mining companies that might be worth building, there's just very little supply that could come online.
Yeah, I want to ask you about looking for really quality, high grade, low cost, low capex, great margin projects like Karma Stream. So those types of streams, in order for you guys to go out and find those things are few and far between then?
Yeah, they're absolutely hard to find, and when you do find them, you got to make sure that you're capable of structuring a deal that makes a lot of sense for the mining company. So Karma was a good example of how we were able to surface value there, despite there not being a lot of mines that make sense to put into production. In fact, Karma at one point in time was one of the only junior mining companies, or it was True Gold at the time. True Gold was one of the only junior mining companies building a mine around the world, and it was just a good quality project that we were able to get associated with. We recently bought a portfolio of royalties from Teck Resources, and it's got a few projects in there, a couple of which are really high quality and make sense building even in low commodity prices. Hop Modern, for example, is a mine in Turkey operated by a company called Lydia Made in Chile, and for just a few $1 million, we were able to purchase a 2% royalty on the project, and they've already got about 3 million gold equivalent ounces at an average grade of 10 plus grams. And it's an incredible asset that is going to get built no matter what the commodity price is, so long as they can get their permits. And it's hard to find those projects, but when you do, you make sure you invest in them, and that's our job.
Yeah, Nolan, it looks like that Hot Modern royalty is going to pay for the entire deal. Now, I want to ask you about the $50 million bought deal. You guys just put out a new July investors presentation. Initially, you had said that the bought deal was going to be used for another deal for financing you wouldn't use to pay back debt. Has that changed?
No, the plan in the last public disclosure that I gave, including on our last quarterly earnings call, I said that we only were considering raising equity if it was in a situation where we believe it was more likely than not that we would be able to eventually deploy that capital into an acquisition opportunity that we could specifically identify now. I.e., we might not be able to tell the market what we're doing, but we at least think we have a reasonable shot of being able to acquire something. So when we pulled the trigger on the financing, that was the case. We were looking at a couple of things that we thought between the two of them, it's a good chance that one of them will land, but they're still fairly early stage in the sense that we're still doing due diligence, and there's no guarantees that we're actually going to follow through with the deal. We might not like what we see when we're done due diligence, which does happen sometimes, but certainly we are working on deals, and we hope those will come to fruition. And if they don't, worst case scenario, we ended up just paying off our debt, and now we're a debt-free company.
That makes sense. Obviously you guys are at 20 assets online now, generating cash flow. So I think you're a totally different company than you were 3 or 4 years ago. Other people though don't see it that way, but 3 or 4 years ago, you had 6 streams online and they were all from juniors. So I think it's a totally different company that Sandstorm Gold has transformed into.
Yeah, I appreciate that. We've worked hard and turned ourselves from a company that, if you think of us 5 years ago even, we had, as you said, maybe 7 to 10 streams and royalties. Only a couple of those were up and running it and operating. And today we're a company with 131 streams and royalties, and 20 of those are operating. And we've gone from having only 12% of our production from majors and mid-tiers, where the bulk of our production came from junior mining counterparties, which is inherently more risky. Today we stand here with more than 3/4 of our production from majors and mid-tiers. And so it's just a completely different risk profile and level of diversification than we had a few years ago.
Yeah, and I think the way this business model works for you guys, right now your valuation is lower than the larger royalty and streaming companies like Silver, Wheaton, and Franco-Nevada, and Royal Gold, and Osisko. But I think you guys have laid out the path to do that and change the valuation. I think your book value last year at one point, you guys were selling at almost a 40% discount to your book value, and now you guys are almost on par with your book value, I believe.
Yeah, that's the case. And candidly, I think that it will take us a number of years to eventually trade at the types of multiples that Franco-Nevada trade at. And in order for us to get there, we're going to have to continue to make acquisitions and continue to diversify and continue to grow. And that's our plan.
I want to ask you about the gold mining industry in general. Now the gold miners are finally starting to make profits again in the last year or so. Do you think the industry has done a good job cutting costs since 2011?
I wish I could answer yes to that question, but I really think that the cost cutting on a per ounce basis has come from two predominant areas. The first is by high grading the mine and trying to increase the production just so that you can get enough cash flow to pay off your debt and stay alive. And that isn't actual cost reduction, that is throughput increase. And it appears like it's cost production on a per ounce basis because you take the same cost, you just have more ounces to divide them over. And that can only continue for so long before it's only the low-grade material left in your mine, and then you've got the same level of costs, but lower number of ounces, and so your costs go up even higher than they were before this whole exercise started of high-grading the mine. And so I'm not optimistic that that portion of the cost savings is going to be able to continue. In fact, I think it might make costs actually go up in the future. And then the second broad category of types of cost cuts are companies panicking and just slashing any and all, quote, unnecessary services or activities and laying people off. And basically, there's a number of mining companies out there running around doing their work in a non-sustainable way. I mean, they haven't been replacing the tires on their trucks as quickly as they should, which is going to cause more wear and tear. They haven't been doing some of the sustainability and community work that they used to invest in, which eventually is going to come back to bite them. They have taken some of their workers have taken temporary wage reductions, but that can only last for so long. And so I really do think that cost reduction is not sustainable either. As soon as commodity prices come back in, there's a dearth of investment that's happened in those types of things and a dearth of investment in the sustaining capital. And so these mining companies are going to have to do extra investment to sort of catch up and get their operations back up to snuff eventually. One area where there has been true cost savings is the cost of energy has come down with respect to diesel. So if you're an open pit mine, your cost of production has come down a lot because it doesn't cost you as much to move all the dirt and all the waste. But even if you're a mining company that isn't an open pit operation and a lot of your energy costs are electricity costs have gone up around the world. So from a high level perspective, other than the price of oil decreasing here, I'm not optimistic the mining industry is a new low cost place. And I think that if gold goes back up to $1,600, $1,800, $2,000 an ounce, which I do believe it will, investors are once again going to be absolutely shocked when the cost of production goes through the roof and they're not making as much money as an investor as they thought they would.
It's a great point. I want to ask you about base metal miners. I think they're in trouble. The global economy is slowing down a lot. China's slowing down a lot. They don't need as much copper and iron ore and steel and things like that. Are there a lot of base metal miners desperate to sell byproduct gold and silver streams out there?
Yeah, there are some out there. We've been talking to a few, and so of some of the other streaming and royalty companies. I would say that there has been a temporary abatement in some of that desperation level. Companies that were willing to sell large streams and royalties have taken a temporary pause because the price of zinc has come back, or the price of other primary commodities that they're mining has come back a little bit, and the debt markets, the secondary debt markets, are getting a little bit better, so they can roll their debt more easily, and so they've sort of pulled back from that a little bit. But they are walking a very, very fine line from a liquidity perspective, and all it's going to take is a bad couple weeks in the markets where there's some financial scare, some bad news about China, or some bad news about Deutsche, or some bad news about something, and copper goes from $2.12, which is what it's at today, to $1.90, and all of them are going to rerun their Excel spreadsheet models going, 4 years from now we're going to go bankrupt unless we do something, and all of them are going to be scrambling to raise capital, whether it be via stream or equity or other forms. So I think it's very risky to invest in base metal companies right now because they don't have a lot of liquidity, and I am concerned that maybe not this year there's going to be a recession, or maybe not even next year, but we're probably closer to the next one than we are to the last one, and these companies are walking around with not a lot of financial liquidity.
Yeah, I think there was a lot of higher cost marginal supply brought online since 2009, and China did all those stimulus packages, building out all the infrastructure and all the capital investment that they made for infrastructure and fixed investments in their economy. And a lot of people didn't see, the cutback in demand coming from China, but I think that demand was artificial.
Yeah, and it was temporary, and supply was increasing as well, because there had been a lot of years of higher commodity prices, and that had brought on a lot of supply, and even as copper came off a year or two ago, a lot of the copper mines, because they're so big and they take so long to build, it's just now that they're actually coming online. So you've got supply technically increasing, even though the prices are at a point where it doesn't make sense to build mines, just because people are finishing the construction of mines that they started building 4 years ago, and that's hurting the price as well. So it's just a tough time to be a base metal miner.
Do you think then that would make it open then for syndicate deals where I heard on Wheaton's conference call, they mentioned publicly that they were being contacted by a bunch of copper and base metal miners looking to sell silver streams. Do you think that would be an option then for syndicate deals in the future?
Yeah, potentially there are a couple of syndicate deals in the works, I think, between some of the larger companies where they're multi-billion-dollar deals. So that's not in the ballpark of the types of size range that we're looking at, but there are some smaller deals that we have talked to counterparties about syndicating. Nothing's advanced at this stage, though.
I want to ask you now about the geopolitical risk in Argentina. You made the investment into Yamana Gold with that large silver stream coming online in, I think, 2019 from Cerro Moro. Did you see the geopolitical situation improving drastically going forward?
Yeah, I did. I'd been following it maybe a little closer than the average person does. I got a very good friend of mine who is a well-known businessman in Argentina, and he always keeps me up to date on Argentinian politics. And then it was just over a year ago he decided to go into politics himself, and gave me the entire lay of the land of the political landscape. And in fact, I ended up talking with a few of the campaigns of presidential candidates to understand what their various platforms were in advance, and got comfortable that the two front runners, either of their platforms, were workable from our perspective for investment purposes. And that friend of mine is actually now a governor in Argentina and was successful in his election, but or sure, he's in the Congress. And I think Argentina is a reasonable place to invest in, but I'll give the same caveat that I'll give for most other countries in the world, that it doesn't take much for the political winds to shift in a country and cause it to be a place that you wouldn't want to invest in. So from a political risk perspective, I truly, truly believe that the best way to play it is to be diversified all around the world. Who would have thought the NDP would be in charge in Alberta and Canada dealing with the oil sands. It's certainly not something that I would have predicted. But so I believe that no matter how good a jurisdiction looks, it can always turn bad, and no matter how bad a jurisdiction is, it can always turn good, and just diversify yourself.
Yeah, and I think that's why people investing in royalty and streaming companies are a safer investment, especially like Sandstorm Gold and Franco-Nevada, Silver, Wheaton, Royal Gold. Osisko only has 2 royalties online now. I think they have more coming, though. But, compared to a regular mining company, the mining company basically has to gamble. They have to put all of their money into 1 or 2 mines, and if something goes wrong, the mining company could go bankrupt or have to sell a large stream on the mine or something like that.
Exactly. I mean, companies like Centerra, and people were wondering why they're going out and buying Thompson Creek. Well, the answer is political risk diversification. The more assets you have your investment base spread over, the less risky it is from a political risk perspective. And companies like us with 131 streams and royalties all over the world, there are very few countries in the world that have the ability to give us heartache as an entire company.
I want to ask you about silver streams. You added the one with Cerro Moro that's going to come online. You have the backup streams, I think, with Chapada and the Minera Florida, if I got that right. Yep. Are you looking to add additional silver streams since the gold to silver ratio is still in favor of silver?
We are. So gold is our primary focus, but we still really like silver here. I think silver could go to $30. In fact, I think it will go to $30. And we are looking to add some silver.
Yeah, I think that would be good. I think gold and silver are really good. There's some people, though, that don't like silver on a gold royalty and streaming company. I think it gives good diversification there. It adds a little extra pop, too. When gold moves, silver normally moves even faster or higher.
Yeah.
Okay, well, I want to ask you about the Teck Resources royalty package. I've heard from other gold mining sources that there's other packages available. Do you think you got one of the better ones in the Teck one?
We do. When we look at it, we paid about $17 million US for the package of royalties. It comes with a few that are already cash flowing $1 to $2 million a year immediately. But then there are a number of other royalties in there. So there are a total of 52 royalties. But Hod Maden, for example, we've talked about that very briefly. I think once that asset's up and running, it has the potential to cash flow $5 million a year to us just on our royalty alone. So that royalty should pay for the entire portfolio of 52 royalties multiple times over once that asset's up and running. And there are a number of other good royalties in there as well. Even sleeper royalties like Hackett River, which is an asset in Nunavut in Canada that a lot of people think it's going to take many years before it goes forward, and I think that's probably true. But it's a highly economic asset. It'll be a very large, low-cost producer. It was an asset that Xstrata bought, and Xstrata was pushing forward very quickly until they got bought by Glencore, and then Glencore put the brakes on all development around the world, including in Hackett River. But we picked up a 2% royalty on that on the entire project, and just our royalty alone should cash flow us $8 to $10 million a year, depending on what commodity price assumptions you use, every single year of the mine life. And to put that in perspective, again, we only paid $17 million for all 52 royalties from Teck, and we only allocated a couple of $1 million to this royalty in the purchase price allocation. So there's just incredibly deep value there, and there's a number of other interesting exploration projects and a number of other advanced development projects as well, and some of the assets are going into permitting as we speak, and so it's just incredibly deep value. If you actually look at the stock price chart of Teck, right at the bottom is when we were able to negotiate that transaction. Now, having said that, we paid for it in shares, and it turned out to be a win-win because we've done very well as a company, and Teck was able to ride those shares up, and they've made a lot of money off it as well. So it was a good win-win, and we'll try to do more of those.
Yeah, do you think there's a lot of other royalty packages available, or there's not really as many? You probably got one of the better ones, and the odds of finding like a royalty package that good are very low.
There are other royalty packages out there that are fairly decent. We've been aware of this Teck royalty package for many years, and in fact, we tried to buy it in the past, but when the markets are good, non-core assets tend not necessarily to be for sale, so we were not able to pick it up. And when Teck wanted to sell their non-core assets, because times are getting tougher in the mining industry, that's when we were able to pick it up. So I think we're just going to continue to monitor the various royalty packages that are out there and continue to keep a dialogue with these companies. And we will attempt to strike when the iron is hot and when these companies need capital.
Are you finding that there's more competition and it's more difficult to get deals done now that there's more royalties and streaming companies being created in the last couple of years?
So I guess looking at both supply and demand, there is a higher supply of streams and more companies willing to do them, and there's also a higher number of streaming and royalty companies willing to buy them. So both the supply and the demand have gone up, and I would say today compared to 4 years ago, it feels about the same. A lot of people forget, though, that even if you go back to when Sandstorm was created 8 years ago, back then we had Silver Wheaton was there, Franco-Nevada was there, Royal Gold were all still there, but you had Gold Wheaton, you had Silverstone, you had a couple of other smaller ones. You had IRC. IRC got bought out, Silverstone got bought out, Gold Wheaton got bought out, and so the industry had a lot of competition. It consolidated itself. There have been a couple of companies that have been created since then in Sandstorm and Cisco, and there'll probably continue to be consolidation in the industry going forward. So it's got a fairly good control at the top of the industry in terms of a reasonable number of companies, depending on what the supply of streams and royalties is at any given time.
Yeah, I think that's a good point. David Morgan, the Silver Dash investor, him and Chris Marchese are launching Lemuria Royalty. I think they just put out a PR for their first deal, and they're planning on going IPO in a couple years. And then I think Pan American Silver just did a spin-off and then a reverse merger with Maverick Metals, and I think they're on an exchange too, as a small royalty and streaming company. So we are seeing some smaller ones, not as large as Sandstorm, obviously, or Rico Metals, even for that matter. Now, some of your critics, I've read some articles on Seeking Alpha. Some of them are critical of Sandstorm Gold. We do like to, hear what critics have to say. They say you don't have a lot of growth from now until 2019. Is your goal to fix that soon?
Well, we've got about 20% plus growth between now and 2019, and we think our cash flow is going to have about 50% growth between now and 2021. Having 50% growth where 100% of that growth is already paid for is a dramatically better growth/risk profile than a mining company. Even mining companies that have 50% growth profiles over the next 5 years, they haven't paid for a lot of that growth. They've got to actually go and build the mines and spend the capital to do that growing. Our 50% growth is already bought and paid for. We don't have any payments that we have to make to any companies whatsoever. And because everything is paid for, 100% of our free cash flow is available to go out and buy more things to add to that 50% growth profile. So if you look at that profile and say, do I think Sandstorm is going to do new deals over the next 5 years? Well, the obvious answer to that is yes, we're going to do that. So the actual growth that we should be able to realize should be well in excess of that 50% over the next 5 years. And if we didn't double the size of the company over the next 5 years, I would be surprised. And so do we have a lot of growth? I would say compared to the average mining company, we have not only more growth, but lower risk growth and growth that's already been paid for.
Exactly. I would say it's a lot safer growth. You don't have to gamble the entire company on bringing one mine online.
Yep, exactly.
Now, I want to ask you about Menor and Luna. It looks like Luna's gotten some financing and some investment from AngloGold Ashanti. Do you expect then that more of your smaller junior counterparties like Menor Resources and others could potentially be bought in the near future?
I think it's potential. I'd put them in two different categories. So if you look at Menor, they're a small producer. They have the potential to be bought, but I'm not counting on it. In fact, if you look at that growth that I just talked about, we assume that Menor is not in production by 2019 and that it just ceases to be. So any continued exploration upside and continued operation of the asset beyond that would just add to those growth numbers that I just talked about. But that's a smaller percentage of our overall value. I figure Menor is about 2% of Sandstorm's NAV. A more meaningful piece, obviously, is Luna and their Aurizona project. And so about a year and a bit ago, a private equity firm from Australia called Pacific Roads came in and they provided them with both equity and debt financing and have pushed the mine forward and done an infill drilling campaign and have initiated various studies. And they're about to put out a study here, I believe, either at the end of Q3 or during Q4 of this year. And they want to get this mine up and running and a hard rock crushing and grinding circuit built and put the asset up into operation And I think that would be great news for us because we have a 3 to 5% NSR on the project, and we also have an equity and debt and interest in the company. Simultaneously, they've got 190,000 hectare exploration property that they call their Greenfields project. It's separate from their main Aurizona mine, and that's the one that AngloGold Ashanti has just joint ventured into, and we're eager to see the results of them starting to spend money on that program because we have a 2% royalty on that project as well.
Yeah, I read your annual report when it came out a couple of months ago, earlier in the year, and it just seems like there's so much hidden growth in the company. You were talking about in your annual general shareholder meeting video that you put on your website that there's a lot of right of first refusals, and there's also so much exploration upside in your potential royalties that are not cash flowing right now that the market's just not counting any of this. Also, I think another point that's valid is all your operating cash flow last year, I think it was replaced by your streaming partners, that just the market thought a lot of the streaming partners wouldn't be able to replace their reserves as quickly as they were able to.
Precisely. 2015 is a year that had almost record low exploration spending in the industry, or at least in recent history. And despite that, Sandstorm and the underlying properties of our royalties found more ounces than they mined during the year. So if you think of being an investor in Sandstorm at the beginning of the year, you figure you have so many ounces in the ground at the company, and you were able to get all of the cash flow for the entire year. And at the end of the year, you look and there's actually more ounces than there were at the beginning. And that's before accounting for acquisitions that we made. We obviously then further increased the ounce figure by acquiring things during the year. But we're starting to get into that phase where it's becoming perpetual in the sense that the companies are continuing to find ounces as they're producing them. And we don't have to pay for that exploration. So it's sort of this semi-perpetual royalty, and it's fantastic. We're excited that we're finally at that phase of the business where we've got enough diversification that you don't know if it's going to go well or poor in any one asset, but you have so many assets that it acts as a portfolio that continues to replace its reserves. And so we're looking forward to hopefully that not only continuing, but now that the gold price is ticking up a bit and some of these junior mining companies and some of the mid-tiers and even some of the majors are able to raise capital and allocate more capital to drilling, we think that effect will pick up even more as time goes on.
Yeah, I've looked at a lot of gold mining companies. A lot of gold investors, though, are looking for optionality. That's the key word on gold stocks. So they're looking for surprise upside value, a new discovery, a new mine that's brought online, new source of cash flow. I think Sandstorm Gold has arguably as much optionality as any gold stock out there, and the market's not really embedded a high amount of value for the optionality that investors are getting when they buy the share price.
No, and that's okay, and that will come over time. I'm a huge believer in optionality, and I believe it's very mispriced on average in the industry, which is why every now and then when we're doing transactions, we try to embed as much optionality into those contracts. A good example would be when we did the Yamana transaction last year. A very small piece of that transaction was a NSR on their Agua Rica project in Argentina, and that's an asset that likely won't get built for a number of years. But what most investors are unaware of is that we had actually embedded a clause that says anytime between now and the time the asset is half built, we have the right to hand back the royalty and make an additional cash payments to buy a gold stream on the project with certain defined terms as to percentage and whatnot. And the price that we pay is based on the price of gold. So, for example, at $1,400 gold, we'd pay another $220 million, and at lower gold prices, we would pay less. But where it becomes interesting to me is we don't have to increase the amount we pay above $1,400 gold. So if gold's at $2,000 an ounce 10 years from now and they're starting to build the mine, we have the right to pay $220 million to get that gold stream that's worth $220 million at $1,400 gold, but at $2,000 gold, it'll be worth $300 and something million. And so it's this quiet option that most people don't know we have, that one day people could wake up and just the optionality alone is worth $100 million more than what we would have to pay. It'd be $100 million in the money. So we try to embed those types of things wherever we can in Sandstorm, and we like optionality.
Yeah, and another thing you've discussed on past conference calls is a potential dividend. I would like to see you guys have more assets online generating cash flow before you guys start potentially paying out a dividend, maybe 30, maybe 40. I guess it's a subjective number, but I would like to see more than 20 online so you guys have, more geopolitical risk, less geopolitical risk, more diversification of counterparties and things like that before a potential dividend is paid out.
Yeah, there's obviously a lot of gold companies with one asset that pay dividends, and very few that have more than 10. And so we're at 20, but I agree that with the basic premise of the concept, which is the more diversified an asset base, the more stable the dividend is, and I think that's a sound principle. It's one of the reasons that we've been waiting this long to do it, and we're one of the only royalty companies in substance that doesn't pay it. So I think we're at a point right now where we recognize we should pay a dividend soon, that we're going to become a dividend-paying company eventually, and we're just trying to find that right time.
Great. Well, I have two more questions for you before I'll let you go. This one's about BitGold. BitGold now has 1 million customers. Is Sandstorm Gold still invested in BitGold, and do you think that they've done a good job, spreading the word about how people can save in gold, and that I guess long-term that benefits Sandstorm Gold and the gold industry?
Yeah, we do still have our small investment in BitGold. We still own shares. We're very big fans of what they're doing, and I'm a personal believer in what they're doing. I've got one of their cards, and I'm one of those 1 million users. And in fact, I was one of the first external users that they had, and continue to use that card. And we're actually at Sandstorm. We are going to be working on creating BitGold accounts for our executives, so that we can reimburse their corporate expenses as they travel and go to conferences or buy plane tickets and those types of things, that we can reimburse them in gold ounces, so that Sandstorm's G&A expense accounts will actually be run in and denominated in gold ounces. We want to be one of the first gold mining companies that actually regularly uses gold as a currency in our day-to-day operations. And so we're working with BitGold to do that, and I'd imagine by this time next year we'll have that all rolled out and working.
That's very interesting. And BitGold has actually talked about, I think they already have in their platform that companies can pay out dividends in gold. So maybe when Sandstorm Gold does start paying a dividend, maybe shareholders will have the ability to get their dividends in BitGold.
Yeah, certainly there will be some investors that are going to want it in cash and some that are going to want it in gold, and we're working through the administrative angle of it right now, but we think it's probably a viable option to give investors their choice. And if they choose gold, then we think that through BitGold we'd be able to actually pay them a dividend in gold.
Very cool. Very cool. I mean, yeah, it's a really exciting company combining technology and mobile payments and saving in gold. I think it's got a great business model.
Me too.
My final question for you, Nolan, you talked about in your new slide deck and also in your general shareholders meeting, your goal was to pay off debt. So I guess the debt's now gone. What would you like to see accomplished in Sandstorm Gold then for the next year or two?
Well, I think over the next year or two, our job is clear, which is to find a couple of good acquisitions, continue to do exactly what we've been talking about, which is continue to diversify our asset base and grow a little bit and get to that stage where it does make sense to pay a dividend, and keep on keeping on. It's not a race. This is a marathon, and we're about 8 years into building this company, and I'm looking forward to seeing what it looks like 8 years from now.
Yeah, that's a great point. I mean, I was talking with Denver Harris in emails over a long point, and I was trying to compare the growth Sandstorm Gold has had to Franco-Nevada or Royal Gold. Sandstorm Gold, I guess, was built from scratch. The other guys, including Silver Wheaton, which you worked at, those ones were built with capital from other large mining companies, right, that already had packages of royalties.
Yeah, exactly. When Silver Wheaton was spun out, it was just shy of $500 million market cap out of the gate on day one. And so when they were launched, they were just slightly smaller than we are now. So it's taken us about 8 years to get the critical mass from a market cap of 0 to being about the size that they were when they were launched. And we finally have that critical mass and deeper access to capital and a strong team, both technical and operational. And so we're excited about having hit that critical mass and being able to leverage off of it to make gains for shareholders going forward.
Yep, and I am a shareholder. A lot of people know that. I mean, I haven't hidden that. But I'm really proud of what you guys have been able to accomplish. The last couple of years have been rough. There's been misallocations of capital. The gold price has been low. But I think really the last 3-4 years you and your management team over there have just done a marvelous job of transitioning the company, adding these royalties on, diversifying the cash flow, improving the counterparties, etc.
Well, thank you very much. I appreciate that.
Okay, well, if our listeners want more information about Sandstorm Gold, how do they find it?
Well, they can go to sandstormgold.com, sandstormgoldltd.com, and they're always welcome to phone us here at Sandstorm as well. Just look up our number on the website, and we're happy to answer questions.
Okay, great. Well, thank you for your time, and hopefully I'll have you on again soon, and we'll be talking with a higher gold and silver price.
Well, thanks very much.